Hello there. Welcome to Zimsec O-Level Principles of Accounts. Today we want to look at a question paper that was written in 2020. This is the first question number one on that paper. The question requires us to prepare an income statement, and also it goes on to ask on the preparation of a balance sheet. So this is a sole trader or a sole proprietor, that is one person operating a business. Remember, we've got three types of business, that is a sole trader, a partnership, and a company. Right. For today, we want to look at the financial statements, that is the balance sheet and the statement of comprehensive income, which is the income statement for a sole trader. This is the question that we have, and the question reads, the following trial balance was prepared from the books of Ben Kopu, and then trial balance is at 30 June 2018. So this is where the year is ending. It's ending on 30 June 2018. Very important to take note. So what does it mean? It means the year started the previous year. Next day from 30 June, it's 1 July 2017. That's where the year started, and then it ends on 30 June 2018. Right, that's what we have. And then we've got some balance that we are given in that table. We have got the column for debit and credit, and the balance are here. And then we go down to check what we have for the additional information. So if you go down, you can see that beneath the table, you've got some additional information that is there. We need to go through the additional information before you start answering the question. It's very important for you to go through this additional information before you start to answer the question, because there are some adjustments that are in the additional information that needs to be done. So it might help you not to omit any adjustments as you have gone through each and every adjustment. You obviously be notified as you go through the question now, right? You'll be able to remember where you are supposed to correct or not. So let's go through the adjustments that we have. The first one is reading inventory was valued at 17,000 on 30 June 2018. So what does it mean? It means this is our closing. This is our closing inventory. Remember, the opening inventory is given in the list of balances, and then our closing will be given in the additional information. So 17,000 is going to be our closing. Remember, we are going to adjust for opening and closing inventory in the trading account. Right, go to the next one. Is saying an invoice of $3,000 for goods bought during the year from James Moyo had not been recorded. So what does it mean? It means these goods were omitted from being entered in the books of accounts. So basically, this is an error of omission that is occurred. So we need to enter this figure in the books of accounts. So according to this transaction, it means that there were purchases on credit. So when we purchase on credit, we credit the name of the person that we are buying from as a creditor, or the name of the business that we are buying from as a creditor. So obviously, James Moyo is going to be our creditor. We credit James Moyo, and we debit the purchases account. So here we are going to start with the income statement. It means on the purchase part, we are going to add 3,000, and then also James Moyo becomes a creditor or a trade payable. So it means when we prepare our balance sheet again, we need to add the 3,000 to the figure that we have for trade payables. Then we have corrected the omission that was there. Then we got the next one is called customs duties. 2,000 was included in general expenses. What does it mean? We know customs duties are included in the trading account. As we add our carriage, we also add our custom duties. So the figure for custom duties that we have in the list of balances is less with 2,000. We need to add it to custom duties. So we're going to add 2,000 to custom duties. And then in the general expenses, there's a 2,000 which is not supposed to be there. So we need to subtract it from the figure for general expenses. It's now in the profit and loss under the operating expenses. So that's the correction that we have on item 3. Then we go to item 4. Depreciation is provided as follows. We are given on the methods of calculation of depreciation. So on 4, the first calculation is that motor vehicles at 6% per annum on the reducing balance method. As we know, reducing balance method, this is the reducing balance method. We say percentage times percentage is the rate and then we multiply by the net book value, or some might call it the carrying value. That means the same thing. Where the net book value would they found it by saying cost of the non-current asset or the fixed asset minus accumulated depreciation. So that's the calculation of reducing balance method. So we are going to apply that on motor vehicles. Then on furniture and fittings, it's 4% per annum on cost, which means this is a straight line method. So basically, we are just going to say percentage is the rate, then times cost. So the figure that we get there becomes our depreciation for the year. So that's what we have in terms of item 4. Then 5, stationery was $300 on 30 June 2018, and on 30 June 2018, that's where the year is ending. So what does it mean? It means the figure that we are given in the list of balances of stationery represents amount that was paid for stationery, the stationery that we bought, and then at the end of the period we have only $300 of stationery that is remaining. So in the profit and loss under operating expenses, we want to enter the stationery that was used, and the stationery that was used represents the expense. So to find that figure, we are going to say what we bought minus what we still have, and then we are left with the expense. So that's what we are going to do on item 5. Then we go to the next one. The next one is item 6. Provision for doubtful debts is to be adjusted to 5% of trade receivables. And we know trade receivables are the same as debtors. And then what this statement is saying the rate is 5%. And we know that to calculate this provision for doubtful debts for that period, we say percentage times the trade receivable figure, trade receivables. And then the figure that we get is the level of provision for doubtful debts for that year. But then we are going to compare the figure that we would have got there with the figure of the previous year and analyze if there's an increase or a decrease. So if we see that there is an increase of provision for doubtful debts, this represents an expense, and we are going to include it under operating expenses in the profit and loss account. But if it's a decrease, it represents income, and we are going to include it under other income. So that's what we have in terms of additional information. So what we are going to do is we are going to go through the income statement. On the requirement of adjustment, we always come back to additional information to refer back to what we need to do in terms of the adjustment. So we come here in the list of balances. We know that in the income statement, we start with the figure for sales. The figure for sales is obviously the first figure that we enter in that statement. And if you come here, we see that we've got purchase and sales here. And the figures that we are given them in one line. We've got 92,000. And we know that 92,000 represents purchases because we know that purchases have got no more debit balance. So this one becomes purchases and this one becomes sales. So we want the sales. So this one is our sales. So we're going to enter that in our income statement. So go to our answer section. If you come here now on answer section, we have got our income statement for Benikobu for the year ended 30 June 2018. So the figure for sales that we have there is 125. So you come in this column, 125,000. So also, let's take note of the heading that we are going to put on the income statement. What is important for you there, the key areas, set what you are preparing. You are preparing an income statement and state it's for who. It's for Benikobu year in this instance, and state where the year is ending for the year ended 30 June 2018. So those are the 3 points that are very important when you are writing the heading. State what you are preparing, who are you preparing for, what year is it, on which date is the year ending. If it's a company, on company accounts, you state the name of the company for ABC Limited. If it's a partnership, also for Tendai and Chipo, something like that. So that makes it a complete heading. So we know that after sales, we need to check in the question if we've got returns inwards. Returns inwards are sales returns, and they are going to reduce the amount of sales that we have to get our net sales or our turnover. So we go back to the list of balances there and check what we have in terms of returns. I would see that we have returns here, and our returns is 5,000. So we are going to enter this as our returns inwards and they reduce the amount of sales. So here now we say returns. So basically we are saying less returns inwards, and the returns is 5,000. And always we know that we are saying less, so we are subtracting here. You can show by brackets that we are subtracting, and then we can be able now to calculate the net figure there. 125,000 minus 5,000, you get 120,000. Right. So the figure that we got here is the net sales figure. Is the net sales figure, or we can call it the turnover, depending on the terminology that we are going to use there. Net sales. So 120,000 becomes our net sales, and we know that from there we go to less cost of sales. We go to less cost of sales, and obviously we can underline our cost of sales. And under that, we calculate the cost of sales. Now we start with opening inventory. Start with opening inventory. So this is what we have. Then we go back to check the figure for opening inventory. And always the figure for opening inventory will be given in the question, in the list of balances. Here is inventory, and we are given it as what? As 12,000. So we are going to add that figure. We come here, opening inventory, we are going to put it in this column, and they will say 12,000. And from there we add purchases. We add purchases, and then the figure for purchases again, we go and check in the list of balances. Our purchases here, and it's on the debit is 92,000. So we can go back and put that one, 92,000. 92,000. Right. On purchases again, remember, I think this figure we need to correct it here. Remember, for purchases, we put something to do with purchases in the additional information. Let's go to the additional information. Right. When we come to the additional information, we had something that was omitted, if you still remember. So we come here. So that's important of you to go through the additional information before you answer the question. You can be able to remember that there's an adjustment that is concerning a certain entry that you are making. So we come here, an invoice of 3,000 for goods bought during the year from James Moore had not been recorded. Remember, we said this one is we are going to add purchases, and then we are also going to add the trade payables in the balance sheet. So 3,000 we add to the figure that we have for purchase there, which is 92,000. So we go back there and summarize that working. So here in brackets, we are going to say we have 92,000. That's the figure that we are given, and then we add our 3,000 that was omitted. Then obviously we get 95,000. Right, that's what we have there. Then you also need to, before you enter the pages, also another requirement, you're supposed to check if you've got returns in the question, but generally in this question we do not have purchase returns, because you need to remove them from, to subtract them from purchases so that you get the net purchase figure. But we don't have that one. So after that now, we check if you've got carriages in the question. So we start from top, set, look for carriages or custom duties. We have got custom duties here, but carriages, we see we do not have any carriages in the question, but custom duties are there. So we can take this figure, custom duty 8,000, and we are going to put it just beneath the purchase figure. So we come here, we are going to write our customs duties, our customs duties. Right. On our customs duties, remember the figure that we have there. The figure that we have there, also we have got an adjustment that is there on additional information. We go down. We got something to do with customs duties. On item 3, we come here. Customs duty of 2,000 was included in general expenses. Remember, we said this adjustment, we are going to remove it in the general expense figure, and then we add it to customs duties. So It's a plus 2,000 for the figure that we have for customs duties. We go back to our answer section, and we can summarize that work in there, so that so we are going to say the figure that we are given is 8,000, then we add 2,000. So here in brackets, you can just say 8,000, then add 2,000. Right. So when you do that, you are going to get 10,000. And obviously, that's all we have in terms of those carriages, and customs carriages are not there. Then we have customs, then we add our purchase and open inventory. So if you add the 3, you're supposed to get 117,000. Right. So that's what we have there. Then we know that after that, we are supposed to subtract the closing inventory. So we can go back again. Here we now have closing less closing inventory. And this figure, we can always get it in the additional information. The figure for closing inventory, we are given it here as 17,000. So we can go back and subtract that one. If you come here now, we are saying 17,000. And remember, we are saying less, so we are subtracting that figure. And the net figure that we are going to get there, it goes the other side. 117,000 minus 17,000, we get 100,000. So here now, we are having 100,000, and we remember this figure now represents cost of sales. So this is the figure for cost of sales, 100,000. And for cost of sales, we are saying less, so we are subtracting. So it's in brackets. Then now say the net sales figure minus the cost of sales figure to get the gross profit. 120,000 minus 100,000, you get 20,000. So here we have got 20,000 representing our gross profit. Right. So that's what we have. Then we also after that, now we go to add other income. So here now is add other income. Right. On add other income, we check if we have got any income there, but according to our question, we should have one income that is there. We check in the list of balances if we have got any income that is there. Might have a commission received. Commission received also is one of the incomes that we might have. If there's disposal of non-current assets, profit on disposal can come under also under other income. We check, go down, looking for an income. We go down, we go down, we go down, we go down. Right. You see that we are not seeing any income. So when we are not seeing any income, the next stage that we have to do to check if we've got any income that is there, to check if there was a disposal of a non-current asset in the additional information. You go to the additional information and look for a disposal of a non-current asset, and you see that there's nothing like that. There was no non-current asset that was disposed. So what we have to do now, we have to check if we have to go to provision for doubtful debts also to check what happened to provision for doubtful debt. So I'm emphasizing that if you don't find any income in the list of balances, first of all, check if you have got any disposal that has taken place in additional information. Because we might have a profit on disposal and the income included under income, it won't be listed there in the list of balances. And secondly, we have to check for provision for doubtful debts. If there is a decrease, was a decrease in provision of doubtful debts, remember we said it's income. Provision for doubtful debts, we said it's income. Remember here we highlighted that when there's an increase, it's an expense. When there's a decrease, it's an income. So we check for provision for doubtful debts if we have a decrease. If you have a decrease, we have to put it under other income. So we have 5% as our rate. Then we check the balance of trade receivables in the list of balances. Trade receivables. Right. Trade receivables, we are seeing that the figure for trade receivables is here. Same line with trade payables, but trade receivables is an asset, so it's come on the debit. So 11,000 is the figure that we have for trade receivables. So how do we calculate that one? We are going to say 5%, 5% of 11,000. 5% of 11,000. So basically, we are going to do say 0.05, which is 5%. Then we multiply by 11,000. And when we do that, you are going to get 550. Then you compare it with the last year's provision for that and see if there's got increase and decrease. So for last year, we've got here. That's where we've got the figure for provision. You see that here. This is the provision figure here. We are giving the provision for bad debts 1 July 2017. At the beginning of the previous year, it was 600. So this belongs to last year. Beginning of the current period that we have is 1 July 2017. So that's the opening, which was there last year. So 600. So what does it mean? It means it moved from 600 to 550. So it's a decrease of 600 minus 550. So we get that, see that there's a decrease of 50. So we go to our answer section and we just put our provision for that dates under other income is income. So when you come here, we now write provision, provision for bad debts. Provision for bad debts, and we found it as 50, so we put it here 50. And it seems as if this is the only provision that we have, so this 50 also is going to come here. We can put it here. That 50 is going to come there. So that's what we have there. And then we now extend our line here. As you know, I'm now saying 20,000. Remember, it's other income, so we are adding 20,000 plus 50, we get 20,050. So that's what we have there. And then the figure that we are going to get there, it's gross income. Right. Other than that, now we go to less expenses, less operating expenses. Right, so we can underline here because we are going to list all the operating expenses beneath that. Right. We try to move our page up there to create space. Right. We are going to the list of balances, and when you go to the list of balances, we are going to look for any expenses that are there in the question. So we are going to start where we have got the list of balances starting, and then we go down to check any expenses that are there. So we start from here with capital, we go down looking for expenses, 10 inwards, we adjusted them in the trading account. The same with custom duties. And obviously we've got also provision for depreciation, which we are going to also calculate. And then we've got we are looking for any expense. We come here. We have also stationery, 3,600. Stationery that was bought is 3,600. But we have got stationery that was left during at the end of the period in the additional information that we are supposed to subtract from that figure to get the stationery that was used as an expense. For stationery, we are told that go down for stationery. It's here, inventory of stationery was 300 on 30 June 2018. So this figure, we subtract it from the figure that we are given in the list of balances, like what I was explaining there. 300, we are going to subtract it from the figure that we are given, which is 3,600. So we go there and summarize that's working. We are here now. We have the first one is stationery. Then in brackets, obviously we are going to now indicate working, which would make us arrive at the figure for stationery. So stationery, we are saying 3,600. Then we subtract the figure 300 that of stationery that was there at the end of the period, and we are going to get 3,300. 3,300. So we have 3,300 here. Right. We go back again. to check after stationery what we have. You see, after stationery, we've got general expenses, and we've got something to do with general expenses on additional information. So we go down, see what is it saying. We have item 3. It's saying custom June 2000 was included in general expenses. So there's an amount of 2000 in general expenses, which is not supposed to be there. We are going to say minus 2000 to remove it. So the figure that we are given is 7000 for general expenses here. So we subtract that 2000. So we come here again and do generally summarize that working. Now we are saying general expenses. General expenses. So in brackets, we are summarize the working. We are saying 7000 minus 2000. Then we get our 5000. And then after general expenses again, we would want to see what we have. We have drawings. Drawings are not expenses. They are going to be adjusted in the statement of financial position or the balance sheet, as they are going to reduce the capital figure. We are going to subtract them under the equity section. And then lastly, we have got bank. So we've exhausted all the expenses, but still we have depreciation. So let's go down to check in terms of the calculation of depreciation. Remember, we are saying motor vehicles is 6% on the reducing balance method, when we are going to employ this formula, whereby you say percentage times net book value, and then our net book value, we first calculate our net book value, which is cost minus accrued depreciation. So the figure that we get is depreciate times 6%. So here you see that the information that we are given there, we have let's try to see. We have for motor vehicles, the cost here is here, which is 15,000, and then the depreciation accumulated figure that we are given for motor vehicles is 2,500. So it's 15,000 minus 2,500. The figure that we get times 6%. So we can just maybe try to work it out there. We say 15,000 minus 2,500 to get the net book value. And obviously, when you do that, we are going to get 12,500. So we now say 6%, which is 6 over 100, or 0.06 times 12,500 over 1 to get the depreciation. So if you do that, you get 750. So here you get 750. So that's what we have in terms of depreciation of motor vehicle. So we can just go maybe and summarize the last working, which is this one, on the workings part. So we go there, it's right, depreciation, and the depreciation that we are calculating for motor vehicles. Motor vehicles, and we are saying is 6%, which is 0.06, and then we multiply by net book value, which is 12,500. And then the figure that we got is 750. So we have 750 here. And obviously we have the next one. We put another non-current asset that is there. Non-current asset that is there. Let's check the balances. Remember, on that one we are saying on costs, right? The furniture and fittings, which is 6,000 cost price, and then the percentage we can recheck. So we get percentage times 6,000. So our percentage for fittings is 4%. So we are going to say 0.04, which is 4%. Then we multiply by the cost, which is 6,000. Then if you do that, you are going to get 240. So this is our depreciation for furniture and fittings. So we can go there and just try to summarize that working for furniture and fittings. Right. If you come here now, it's now furniture. Furniture and fittings. Furniture and fittings. And remember, we are saying it's 4%, which is 0.04. And then we multiply by 6,000. And then obviously the figure that we are getting there is 240. So that marks the end of our operating expenses. So we are going to add there 3,300 plus 5,000 plus 3,750 plus 240. And then we get 9,290. 9,290. So this is the total for operating expenses. This is going to be the total for operating expenses. So we are saying less, and then we subtract. Right. So what are we going to say there? We are going to say the figure that we are given. The figure that we are given there. For gross income 20,050, then we subtract the figure for operating expenses, which is 9,290. Then obviously the figure that we are going to get there is a positive figure of 10,700. And this is our net profit. So what does it mean? This figure, again, we are going to use it in the statement of financial position under the equity section. As we know, profit increases the equity balance. So we are going to deal with it again when we go to the statement of financial position. So this is the statement of financial position that we have. The second part is saying prepare a statement of financial position as a 30 June 2018. And then as for the heading, again, like I was explaining, state what you are preparing for. You are preparing statement of financial position for who, for Ben Gobu, which year, on which date is the year ending as a 30 June 2018. So that's what we have. And then we are going to start with non-current assets here. So on the non-current assets, we are going to create a column for costs, for accumulated depreciation, then for net book value. So let's start by the motor vehicles. This is the non-current, one of the non-current assets that we have. And then the costs, we already know that the cost is 15,000. So we are having 15,000 in this column. And then accumulated depreciation, now we can go back to see how we can calculate it. The figure for accumulated depreciation, we can go back to check how we can calculate it. Right. You see that figure for accumulated depreciation. Obviously, accumulated depreciation, what we are going to do, we are going to say depreciation, what balance that we have in the list of balances. Then we add the depreciation that we got for the year to get the accumulated depreciation. Right. Can you try to see? Go back to check the figure for accumulated depreciation. So for that, we come here, we know that the figure for accumulated depreciation that we are given in the list of balances, we check it, it's up there. It's there. If you come here, you will see that provision for depreciation motor vehicles is 2,500. So this is depreciation that we had before, and plus the depreciation for motor vehicles for this year, we get the accumulated depreciation. Remember, accumulated depreciation explains that depreciation of the non-current asset from the day it was bought until today. So today is the end of the year. So 2,500 is what was there, and what we calculated this year, we add to get the accumulated depreciation. When we calculate depreciation for the year, we got 750 for motor vehicle. So we just say 2,500 plus 750. So we go there and summarize that working. 2,500. So what we are saying 2,500. That what we had in the list of balances plus what we got for the year to get the accumulated depreciation. So if you add the two there, you are supposed to get 15,000. Sorry, you get 2,500 plus 750, you get 3,250. So here's 3,250. So you're going to put your 3,250 in this column. And then now for net book value, you are saying cost minus accumulated depreciation. So 15,000 minus 3,250, then you get 11,750. So here we have 11,750. Then after motor vehicles, we also have furniture and fittings. Remember, furniture and fittings. So you're just going to do the same thing. So the cost price, we know it was 6,000. We calculated it. We saw it when we calculated that depreciation for the year 6,000. So here you're having 6,000 as our cost. Then we go back again to check in terms of accumulated depreciation. Now we are going to say depreciation that we have in the list of balances for furniture and fittings 420, and then we add the depreciation for the year 420 plus depreciation for furniture and fittings 240. So 420 plus 240. So if you say 420 plus 240 here, we are going to get what? 660. So 660 is the accumulated depreciation for furniture and fittings. So you come here, you put 660. And obviously, when you say 6,000 minus 660, the net figure that you get there is 5,340 is the net book value. Then you can put your lines here to get the totals. And then this line is not going to go to the column for net book value. Why? Because this figure is going to be used down there to calculate the figure for total sales. But these ones are just disclosed, but we don't include them in the calculation that are beneath. So we can just close here. Then when we say 15,000 plus 6,000, you have 15,000 plus 6,000, you get 21,000 here. Then here 660 plus 250, you can just add here 0, here 1, here 9, and then we get 3,910. Then if we add 11,750 plus 5,340, we get 17,090. So here 17,090. So that's what we have in terms of non-current assets. Then from there, now we go to our current assets. So here we can just put a heading of current assets. So for our current assets, let's try to see what we have. We know examples of current assets we have for the bank is a current asset. We also have cash is a current asset. And we also have trading stock, trading inventory being also current assets. So here we come here to check the current assets that we have in the list of balances. You can see that in the list of balances there, we have trading inventory. We can start with trading inventory. Trading inventory, we are given it's in the additional information. Closing inventory is the one that we are supposed to include. So 17,000, we have it here as our closing inventory. And we also have the one for stationery. It's also part of that closing. Stationery, remember, we've got something for stationery that was there at the end of the period. Here on 300 for stationery. So we are saying the closing inventory that we are given there plus 300 to get the total closing inventory. So let's check the figure there. Yes, inventory of stationery was 300. So we come here, we add 17,000 plus 300 to get the total inventory. So we come here for current assets. We can start with inventory. So here we are going to say that's trading inventory. So we can just say inventory here. And remember, we are saying 17,000 plus 300. Plus 300. Then we get 17,300 to put in this column. Then from there, we also have trade receivables. Trade receivables, we get the figure. We go to the list of balances that we have there. Check for figure for trade receivables. So obviously in the list of balances that we have there, trade receivables is here. We've got trade receivables and trade payables in the same line, but 11,000 represent trade receivables. So what we're going to do, we are also going to subtract the figure for provision for bad debt that we calculated for the year. The balance for provision for bad debt that we calculated for the year, we subtract it from the figure for trade receivables in the balance sheet. So the balance that we got is here 550,000 for the year for provision for bad debts. We are going to subtract it from 11,000 to get the net figure for trade receivables. So we go there. Then we say trade receivables, the figure that we have is we calculate it in this column since we want to find the net figure. Trade receivables with 11,000, so we have 11,000. And then we less provision for bad debts. And we got it, the figure is 550, and we're saying we subtract it. And then we, the answer, we are supposed to put it here. 11,000 minus 550, you get 10,450. Right. That's what we have there. And then also we check for another current asset that we have in the question. Obviously, we go back to the list of balances. We go to the list of balances. We also have bank. If you check there, here's our last item. I think, yes, here's our last item, bank here, 3,500. So we can go back and input bank. This is our last current asset that we have. So we have bank here. And the figure for bank is 3,500. So we can put it here, 3,500. Then we add the total for current assets, 17,300 plus 10,450 plus 3,500 to get 31,250. So we add this figure to the figure for total for non-current assets, which is 17,090 plus 31,250 to get the figure for total sales here, which is 48,340. So this figure represents total assets. So this becomes our first balancing figure. Then we go to the second part of the question, which is the equity and liability section. Equity and liabilities. Right, so that's what we have. And we are going to start with equity. Remember, equity is capital. So we are going to start with the opening balance of capital that we are given in the question. We add net profit, we subtract drawings. So the figure for opening equity or opening capital, get it in the list of balances. We go there. Capital is the first item that we have in the table. It's 30,680. 30,680. So that's the figure that we are going to input there. 30,680. Then we input that one for opening capital, 30,680. And then we also check the figure for drawings. 30,680 is for capital, and then for drawings, we are having it here. We are seeing it here is 8,500. We are going to subtract it, and then the figure that we are going to add is for net profit. We can check it in the income statement. It's 10,700 that we calculated. So that's what we have there. So basically, here what we are doing is we are employing that formula of saying opening capital. We add net profits. If there's a profit, if there's a loss, we subtract net loss. But in this case, there's a profit, so we add net profit, then we less drawings to get the figure for closing capital. So that's what we are doing on the equity section. So the figure for open capital, we got it. Net profit is here, 10,700. Drawings, we got it. And then we get the closing capital. So we can go there and then summarize that one. So here we're going to start with opening capital. In the figure for opening capital that we have there is 30,680 in this column. You add net profit. So if you have additional capital again, that was introduced during the year. We are supposed to add it, but in this question we don't have it. So we can skip that one. Then we have got the figure of net profit. We got 10,660 according to the net income statement that we prepared. We got that figure 10,760 as net profit, and then obviously we add here. So when you add there, you're supposed to get 14,000. Sorry, you're supposed to get 41,440. 440, and then you list drawings, and the drawings figure we got it that time, and the drawings figure when we checked, the drawings figure was 8,500. 8,500. So you're going to list 8,500 here. So now put 1,440 minus 8,500. Then we get 32,940. 32,940. So this is the figure for our closing capital that we are going to add to liabilities that we have in the question. So here now we are going to liabilities. So you start with non-current liabilities there if we have them in the question, but we check in the list of balances if we have got any non-current liabilities. We are seeing that we are not having anything there. This is the bottom part. We are not having any non-current liabilities come in the form of a long-term loan. If you've got a loan that is there, or a mortgage loan, it becomes a non-current liability. You don't have anything. Then so we only have current liabilities. If you come, let's check here where we have trade receivables and trade payables. So trade payables are current liabilities. So we have 12,400 is our current liability. But remember, we've got something in the additional information which is explaining about that balance of trade payables. You come here, an invoice of 3,000 for goods bought during the year from James Moore had not been recorded. So whenever how do we know that these goods were on credit? We know that there was an invoice that was issued, and whenever the invoice is issued, it means there is a transaction that has taken place on credit. So 3,000 is going to increase the figure for trade payables, and the figure for trade payables that we are given in the list of balances is 12,400. So we're going to say 12,400 plus 300, and we check if we have got any other current liability in the question. Other liabilities that can be in the question, we have accrued expenses can also be current liabilities, and prepaid income can also be current liabilities, but we don't have anything like that there in the question. So we even a short-term loan can be a current liability, but we don't have them, so we can just go and put trade payables there. So we have now trade payables, sorry, before we write trade payables, we are supposed to indicate that they are current. We have current liabilities. We have current liabilities. And then the current liabilities that we've got trade payables. But this trade payables, we are calculating it is 12,400 plus 300. Remember, 12,400 is the one that we are given in the list of balances. 12,400 there. 12,400. Then we add the one that was omitted, which is 300. Then we obviously are going to get 12,400. We add 300. What do we get there? Let's try to see. Let's try to recheck the figure for trade payables if it's correct that we got there. Figure for trade payables is 12,400. And then what do we have in terms of the figure that was omitted? It's 3,000. Sorry, it's 3,000 here. So we are making a mistake there. We're supposed to put 3,000. 4,300 plus 3,000. So here we have 3,000 right? Then we get 15,400. So this one is going to come here, 15,400. Then obviously this is also going to come in this section, 15,400, and it's going to add to this figure for closing capital, which is 32,940. Here we have 32,940. So if you add 32,940, you add to 15,400, you are supposed to get again the same figure that we got there, which is 48,340. 48,340. And it becomes the second balancing figure. You're now seeing this figure is equal to the first balancing figure that we got here, 38,340. And that shows that our balance, our balance sheet is balanced, which is the requirement. So in this balance sheet, what we employed is that basically the balance sheet summarizes the accounting equation where we say assets is equals to capital plus liability. So this was the first balancing figure for total assets. And then in the second balancing figure, we got this one, that is current, capital, which is this one, 32,940. And then the total liabilities that we have there is this one, 15,400. So this one and this one represent this other side. And then we have total assets here, current assets plus non-current assets represent this this part. So when we have an equal amount, it shows that we prepared our balance sheet in the correct way. So guys, that is what we have in terms of this question. This question was the first question in the bulk of marks on that question paper, which is very key. So let's take note of all the adjustments that we've made there. And the most important area is the area of additional information, whereby you have to take note of the adjustment that needs to be done on additional information, and we need to read this before we answer the question, so that whenever we are going through, you can be able to remember. You can see that as we are preparing this income statement and balance sheet, there were some instances that I was trying to omit some transactions that were in the adjustments section on additional information. So without reading the information first before you answer, you can omit some of the adjustments, and your balance sheet won't balance, and you lose marks, which is not good. So guys, once again, I wish you the best in the paper 2 that is upcoming. But stay tuned. More videos are going to come as we prepare for the paper 2. Those who haven't subscribed, please subscribe. Subscribe and share. We'll meet again in the next video. With that, I'm signing out.